If you've got equity in a home or LLC-owned investment property, you are not going to want to miss this video. Do not do it to yourself. We're going to go through every use case and using a HELOC to consolidate debt. So what actually makes sense? A HELOC consolidates almost anything. Car loans, credit cards, MCA on your business, student loans, even the down payment on your next property. But it is the same tool doing 5 very different jobs, and it's a genuinely smart move for some of these and a real gamble for others. So I'm Mick Wadley from Gap Funded. We're talking days, not weeks. Let's get fair up it. The quick refresher. Before diving into specific debt types, here's how HELOC actually works as a financial instrument. Revolving line, secured against equity in a home or investment property, not tied to the income or credit score alone. However, they do boost your terms and rates. Draw and repayment. So typically a 10-year draw period followed by a 20-year repayment period. Variable rate usually runs 7 to 8%, variable tied to the prime rate, so it moves with the market. And if you're doing it on an LLC owned investment property, it's typically going to be 1% higher to reflect the increased risk for the lender. So the big thing to understand first, most debt you consolidate, credit cards, MCAs, personal debt, these are unsecured. Nothing backs them but your promise to pay. If you default, lenders can pursue you, but they can't take your home. A HELOC is secured on the other hand. Your home is the collateral. Missed payments on a HELOC and foreclosure is a real possibility. So you are trading unsecured debt for a debt backed by a house, whether it's a home or LLC owned investment property, and that trade is worth making in some cases and not in others, which is exactly what the rest of this comes down to. Credit cards, the clearest win. Credit cards are the most straightforward case for HELOC consolidation. The math is hard to argue with. A 20 to 25% credit card rate, your HELOC rate on the other hand 7 to maybe 9% on an LLC owned property, and your score can jump 40 to 80 points by consolidating that utilization. Potential gain from dropping utilization in a single reporting cycle, so you could jump up in less than 30 days. Moving a credit card balance to a HELOC at 7 to 8% is a massive rate reduction. It also drops your utilization, which can move your credit score significantly. This is usually a straightforward yes, and it prepares you for other loan options down the line at a better rate in terms. So what about car loans? It depends on the math. Car loans are not an automatic win. Unlike credit cards, some borrowers already have competitive rates, making a HELOC swap pointless or even harmful. So check your actual rate first. Some car loans already sit in the 5 to 9% range. A HELOC only helps if your rate is meaningfully higher. Otherwise, you're just moving a car payment onto your house for no real benefit. Watch for prepayment penalties as well before moving any auto loan. Check whether your existing loan carries a prepayment penalty. That cost can erase the savings entirely. MCA debt, especially if you're deep in. So an MCA is a strong candidate for HELOC consolidation, particularly once you're 3 or more advances deep. So why business refinancing gets hard? Multiple UCC filings can make lenders nervous. The more stacked MCA debt you carry, the harder a straight business refinance becomes, and lenders see the risk and pull back. Why a HELOC sidesteps this? A HELOC is tied entirely to your property equity, not your business revenue or business credit situation. It bypasses the stacking problem completely, so then you become open to going and getting better products like a business term loan or business line of credit. The key advantage, not tied to business revenue or business credit at all, especially useful once you're 3 or more advances deep, where business side underwriting gets genuinely difficult to refinance. So student loans, slow down here. This is the one to genuinely pause on before acting. The protections you give up may be worth more than the rate savings. So federal loans carry real protections, income-driven repayment plans, forgiveness paths for certain carriers, and deferment if you hit hard times. These are built into federal loans by design, so move them and those protections are gone permanently. There's no undoing it. Once federal loans are paid off with HELOC proceeds, every protection disappears forever, and private student loans are a different conversation. Those protections were never there to begin with, so the decision comes down to rate alone, a much simpler calculation. So down payment on a new property, this is a big one. This last use case is different in kind, not just degree. Instead of paying off existing debt, you're using equity in one property to fund the down payment on the next. So tap your HELOC to fund down payment on an investment or a new home. To bridge things as well. So imagine getting into another investment property where there's an equity moment, whether it's a fix and flip or DSCR refinance on a BRRRR method, you use that equity moment to pay down the HELOC and you've got it ready again to go on another investment property. So that's a great way to scale. The math that actually decides this, across every single one of these use cases, the decision comes down to the same core calculation. Compare real rates, watch the term extension, run the total costs. Once you go through this process on screen, you'll know whether or not this is actually the right move to make for each type of debt consolidation or expanding your investment portfolio. So what lenders want to see? On the approval side, lenders evaluate three things closely before extending a HELOC for consolidation purposes. Have you got sufficient equity? Enough equity to support the draw, typically keeping you under 80 to 85% combined LTV across all liens on the property. On a home, an LLC-owned investment property will probably be more like a 75% LTV. Income to support the payment, documented income to comfortably cover the new payment, especially important if what you're paying off is a business related debt like an MCA. They now do business use case HELOCs that take into account your business revenue as well as your personal debt to get approved on better terms. So a clear payoff picture, a clear picture of exactly what is being paid off and why, coming in organized makes this move significantly faster to close. The honest bottom line, let's look at the same tool, 5 completely different verdicts. Here's where each debt type lands. So credit cards, usually a clear yes. MCA debt, usually a clear yes. Car loans depends on your specific numbers and rates. Private student loans depends on rate comparison and whether it's through the government. As it shows here, federal student loans, usually a hard no. Lose income driven repayment, forgiveness, deferment, protections permanently. None of this is a one size fits all, and it's exactly why it's worth running your own numbers before deciding. How we help with this? We look at what you're actually consolidating, not just the HELOC itself. It doesn't make sense for a piece of what you're carrying. We will tell you directly instead of pushing the tool because it's one we offer. Full picture analysis, we look at every debt type you're carrying, not just the HELOC in isolation, to actually determine what makes sense to move on. Straight talk when it doesn't fit. We'll tell you directly when a consolidation doesn't make sense, not just when it does. And structure for maximum impact. We structure the draws so your equity works as hard as possible toward your actual financial goals. Ready to run the real numbers. If you're weighing whether a HELOC actually makes sense for what you're carrying, don't guess. We'll walk through the math with you directly. Head over to gapfunder.com/apply, book a call, and we'll run the real numbers with you. Not a generic estimate, but your actual situation. Worst case scenario, you walk away with a game plan. So know which debt you're holding. A HELOC is a genuinely powerful tool, one of the best, and like any powerful tool, it can do real damage pointed at the wrong debt. So know which one you're holding before you use it. Clear yes on credit cards, MCA debt. The rate savings and structural benefits are compelling. It depends on car loans and private student loans. Run your specific numbers before deciding, and it's usually a no on federal student loans. The protections you give up here are worth more than most rate savings. So gap funded, we're talking days, not weeks. I'm Mick Wadley. There's more on the channel walking through each of these debt types on its own. So you can make a call with full information, not just a gut feeling. And if you adored this video, absolutely loved it, head down, smack the subscribe and flog the bell. I'll see you on the next one.